But let's put the spotlight then on Sami Hotels. The company is talking about a turnaround in their operations as well as an acquisition-led strategy. We've got Ashish Jakhanwala, Chairman, Managing Director and CEO joining in. Thanks so much for taking time out. I just want to start off by talking about this focus on a turnaround in operations that you said will help generate returns. What exactly is the strategy in place to turn around your operations?
Hi, thanks for having us. So over the last 12 years, we built the whole business around identifying underperforming, undermanaged hotels across India. And then effectively, we have a programmatic approach to improve the product, bring a strong brand, have very strong asset management capabilities. And by applying all of those three, we've seen that the performance of these hotels can really materially change, So that's how we've grown over the last decade or so. As of date, actually, we have 4,800 operating rooms. But within that, about 900 rooms are waiting for that turnaround. So we expect to initiate that in the current quarter and complete all of that in the next 4 to 5 quarters. And that would actually create a huge upside impact on the performance of the company as we see it today.
The turnaround of those 900 rooms. And, as you said, that a lot of the properties are in the mid-scale to upper mid-scale category. Your average ARR is around 5,000 odd. In FY23. So how do you plan to grow your ARR, especially in light of the fact that we have been seeing healthy domestic demand?
So yeah, absolutely. So there are two parts to that. One is market driven and one what we are doing. We actually see a very strong demand for business hotels in key cities. And if you know about our portfolio, almost 90% of our revenues come from the key metros. And those are the metros where we are seeing really good growth in office space, really good pickup in the aviation traffic. And those are the two big pivots for us to see strong demand. The supply is negligible, and that is effectively going to push the average room rates higher. But besides those market-led factors, as I said, that we have a portfolio which is a part of our portfolio is waiting for that re-rating through some renovations and rebrandings. And that will also have a significant impact on the average rates across the portfolio over the next 4 quarters. So there are both factors in play here, market-led and what we are doing as a company.
Your revenue, which broadly comes from the Marriott Group. I was on your website and I was looking at your hotels, and a lot of Marriott properties are in your fold. What's the percentage of my business revenue which you get from them?
So if you look at the total portfolio, you're absolutely right. About 50 to 60% of our revenues will come from hotels which are branded under Marriott, and the balance will be split between Hyatt and Intercontinental. So we have a very good spread of brands and operators in our overall bouquet. But about 50 to 60% is hotels which are branded under Marriott flags.
And at a time when more and more hotels are, let's say, following an asset-light model, aren't you thinking on the other side? Because that's the time when you keep your balance sheet less levered, debt is not a challenge. Right now, the cycle is strong. It could be a 2-3 phenomenon, but then after that, hotel is ultimately cyclicality.
So you're absolutely right. I think what is important is to be capital efficient. And if you see, we've taken through a lot of hard work and pain over the last decade to install a very strong capacity. So as of today, we are the third largest owner of hotel rooms in India. The IPO allowed us to deleverage the balance sheet to a reasonable level. The current cycle, which in our opinion will last a few years, will be also used to continue to deleverage the balance sheet to a point where effectively it's stable for all times to come. And then effectively the current installed capacity is producing very healthy free cash. And that's really the free cash which is going to effectively increase the capacity that we have in our portfolio. So we've done the hard work, both financial and manual in a way, over the last decade. And now we're effectively reaping the benefits of the capacity that we've installed. In terms of asset light versus asset heavy, I think we are seeing very strong operating leverage in hotel industry in India for the next several years. And if you are in a cycle where you see strong operating leverage, then being an owner which controls 95% of the revenues, 5% are given to the operators, is actually a great business to be in. But in addition to that, very similar to peers, which currently will have about 10 to 15% of their total revenues coming from asset light. Even in our portfolio, we have about 13% of our revenues coming from a quasi asset light strategy, where we actually, instead of owning the buildings, will have long-term variable leases. These are leases which are 40 to 60 years. These are leases where we share a percentage of our revenue with the landowner or the building owner as a rent and not a fixed rent. So we also have an adjacent strategy, which actually today is contributing almost similar to the top line as would be for some of the other peers we have in the sector.
All right, good to know. Thanks so much for taking time out and joining in and giving us a viewpoint as to how your business is shaping up.